Okay, so there's a huge shift happening in the UAE, and it's going to directly impact how family wealth is protected for generations. With the brand new corporate tax law, well, the old rulebook has basically been thrown out. Today, we're going to break down exactly what these changes mean for you and for your family's legacy.
And that's the big question, right? The traditional ways you might have structured your wealth are now being seen through a completely new lens. Look, understanding these new rules isn't just a good idea, it's absolutely essential for smart planning. So let's dive in.
We've broken this whole thing down into 5 simple steps. First, we'll cover the basics of how family wealth and corporate tax now intersect. Then, we'll get to the single most important idea you need to grasp. From there, we'll see how it all applies to your structure, look at 2 very different scenarios, and then wrap up with what this all means for you.
All right, let's set the stage. How exactly does this new tax law interact with the way family wealth has typically been set up?
Every single part of a typical structure, from the family foundation right at the top down to the companies holding specific assets, is now being looked at through this new corporate tax lens. The key is really understanding exactly how each piece is now seen by the tax authority.
And that brings us to, without a doubt, the most important concept in this entire explainer. If you can get your head around this idea of tax transparency, you'll understand the fundamental choice that every single family structure is now facing.
First up, let's define what a taxable person is. The easiest way to think about this is like a solid, opaque box. The tax authority sees the box itself, they calculate the income that box earned, and they tax the box directly. It's its own distinct, separate taxpayer. Simple as that.
Now, compare that to an entity that's tax transparent. This is more like a clear glass box. The tax authority doesn't stop and tax the box. Instead, it looks straight through it to the people standing behind it, the beneficiaries. The income is treated as if it belongs to them directly.
So this slide really lays out the fundamental choice. Do you want your entity to be a solid brick wall, a taxable person that gets taxed directly? Or do you want it to be like a clear window, a tax-transparent vehicle that just passes the income through? This one decision has massive implications for everything else down the line. Okay, so we've got the core concept down. Now, let's actually see how it applies to the individual building blocks of a typical family wealth structure. The family foundation is so often the cornerstone of everything. Now here's the crucial point. If your foundation has its own legal personality, it is not transparent by default. To get that glass box status, you have to proactively go and apply for it, and you've got to meet a very specific set of conditions. It's an active choice, not a given. And this is where it gets really interesting, because we see this incredible chain reaction. The entities that sit underneath the foundation, like your holding companies and SPVs, they can become transparent too. But, and this is a big but, their eligibility depends entirely on the status of the foundation that owns them. The foundation's choice literally creates a domino effect. Now, family offices, they're a different animal. Whether it's a single-family office or a multifamily office, the default rule is that it's a taxable person. It's a solid box. It gets taxed on its income, including things like management fees it charges. It's treated as a separate, active business.
But wait, it gets even more interesting for family offices that are in a free zone. Just look at this table. If your office is fully regulated by an authority like the DFSA, you could get a 0% tax rate on your qualifying income. But if it's just licensed without that higher level of regulatory oversight, you're looking at the standard 9% rate. It's such a subtle distinction in status, but it has a huge impact on the final tax bill.
Okay, we've got the rules of the road. Now, let's put them to the test. Let's see how these choices actually play out with a real-world example.
So here's our structure. We have a family foundation right at the top. It owns a single-family office and a holding company. And that holding company in turn owns 2 SPVs. One's holding shares, the other's holding real estate. This is a very standard setup you might see.
All right, in our first scenario, the family is on the ball. They're proactive, they understand the rules, and they make a deliberate application to be treated as tax transparent wherever they possibly can.
So what happens? The foundation, the holdco, and both SPVs all become those glass boxes we talked about. The tax authority looks right through them. Their income flows through the structure and gets attributed to the family members directly. The only solid box left in this picture is the single-family office, which gets taxed on its own. It's a really clean, efficient outcome. Now for the flip side. In this scenario, the family either doesn't apply for transparency, or maybe they just don't meet the conditions. This is the default path. This is what happens if you do nothing. And the difference is, well, it's dramatic. The foundation becomes a taxable person, a solid box. And because of that chain reaction we mentioned, the holdco and both of the SPVs are now also automatically treated as separate taxable persons. All of a sudden, you've got multiple layers in your structure, and each one is potentially subject to corporate tax on its own income.
And this really just gets to the heart of it all. You have one structure, but the choices you make create two completely different tax outcomes. It just proves that under these new rules, structure really is everything.
So after all that, what does this actually mean for you? Let's boil it all down to 4 key takeaways that you should probably be discussing with your advisors.
First, you absolutely have to be proactive. Transparency is not automatic. Second, always think from the top down. Your foundation is the key that unlocks transparency for everything else. Third, remember that family offices are treated differently and need their own special consideration. And finally, and maybe most importantly, you must review your existing structure right now. What worked perfectly yesterday might be creating a significant and unintended tax problem for you today.
This new law really forces every single one of us to ask that fundamental question, because the rules of the game have changed and the time to choose your path forward is right now.